Hey guys, what's going on? Welcome back to the channel. So in one of my recent videos, I took a first look at the new ETF from JP Morgan, ticker JEPQ. And if you're familiar with Jepq, this is a carbon copy, but based off of the NASDAQ 100 instead. And the reason why this new ETF is exciting is because Jepq has been killing it lately. It is one of the best performing income-oriented ETFs on the entire market, and the expense ratio is very minimal for what it is at 0.35%. Now, I'm usually not a big fan of ETFs that have a proprietary research process, but whatever they're doing here, it's really working. And not to mention, these ETFs are some of the few on the market that use ELNs, and so far, in comparison to covered calls, they are very effective. In fact, one of the best comparisons we can make to see just how effective this private management and ELNs really are is to compare it against QYLG. Because between this and JEPQ, they're based off of the same index, they have the same overall strategy of income as well as price appreciation, but they go about it in two completely separate ways. QYLG is completely systematic. They do the same thing every single month on repeat. And JEPQ is the exact opposite approach. They have managers, a proprietary research process, and ELNs. And lucky for us, there's also a version off of the S&P 500, so we can do a direct comparison between this and Jepq, which has a longer track record. Okay, so when it comes to JEPQ, this is how the ETF functions. So this invests significantly in large cap stocks found in the NASDAQ 100 index while pursuing lower volatility. The fund may invest up to 20% of its portfolio in equity-linked notes issued by counterparties including banks, broker-dealers, or their affiliates to provide additional income. In managing the fund, a proprietary investment approach is utilized wherein data insights such as fundamental research, company fundamentals, and alternative data from public disclosures are extracted, processed, analyzed, and combined in order to identify securities with attractive valuations. They also take ESG into consideration, and this is pretty interesting. So the fund may still invest in other equity securities not included in the benchmark as the advisor deems fit. So we can see there's a lot going on with JEPQ and its active management. Now, in comparison to that, here is how QYLG operates. So this is passively managed to provide both the potential for growth and some yield from the NASDAQ 100 index. Historically, investors came to the NASDAQ for growth, not yield. The fund matches QQQ's NASDAQ 100 exposure, but earns some income by selling 1 month at the money call options on half of the portfolio. The option premiums received are passed on to investors net of fees. Expect a generally less volatile return pattern from QYLG in relation to QQQ. Okay, so right there we can see that both these funds operate in the same space and have the same overall strategy. QYLG is very passive in nature. We see exactly how it operates. It strictly follows the QQQ and it earns income by selling 1 month at the money call options on half of the portfolio. For JEPQ, about 20% of the portfolio is the ELNs, which generate the income, but the rest of it is a proprietary research process to identify undervalued companies, and management has the ability to invest in companies not found within the NASDAQ 100. But both of these should also give you less volatility due to the consistent pretty high monthly income. Now, as mentioned, JEPQ has only been around for about a week, so the price history is extremely limited, but so far, side by side, we can see that they do follow a very similar price action. But to gain more historical insight, let's compare the history of Jepq versus QYLG, which are both the S&P 500 version, and they operate in exactly the same way. And here, the performance, even though the strategy is completely different, is very similar, but we do have some key takeaways here. So Jepq is the blue line and QYLG is the green line, and right off the bat we can notice that Jepq does indeed have less volatility in both directions, keep in mind. So back in November, December, Jepq was lagging QYLG, but now more recently with the crash, it's holding up a little bit better. But I gotta say, overall, the similarity between these two funds is striking. To give you more exact numbers, since the inception date of QYLG, which is the younger of the two funds, QYLG has an annual return of 13.04%, and Jepq over that same time has an annual return of 13.91%. So that's not a ton of history to go off of, but again, extremely similar between the two funds. And if we want to separate the returns between dividends and price action, this is just the price action of the two funds right here, side by side, over the past 1 year. And again, Jepq does have a bit less volatility overall. But if we take a dedicated look at the dividend, here's where Jepq pulls ahead by a little bit. So on Seeking Alpha, Jepq has a dividend yield of 9.84%. If we take a look at the dividend history of Jepq, they pay out on a monthly basis, and it's performing very well even during all this market volatility. And if we look at the same data from QYLG, here the dividend yield is 6.6%, which is still way above average, but it is a little bit less than Jepq. And if we take a look at the dividend history, it does pay out on a monthly basis, just like Jepq, and it's been performing extremely well so far in 2022. And this similarity between the dividends does indeed confirm that the ELNs are pretty similar to the covered calls, because that's what's responsible for generating the vast majority of this income. So that's the side-by-side performance of Jepq and QYLG, and I fully expect the similarities to be the same between Jepq and QYLG. Although something to keep in mind is that Jepq and Jepq are actively managed. And what that means is that their future performance is going to be a lot less predictable, because it depends on what management does and the decisions that they ultimately make. And that does go in both directions. So sometimes the management of Jepq could predict a market trend and thus give you outperformance, but other times it could lead to underperformance if management makes the wrong decisions. In terms of QYLG and QYLG, because it's systematic, we know exactly what to expect, and it's going to pretty closely follow the performance of its index with the addition of pretty regular monthly income. So it really is a tough decision between these two very similar but yet very different types of funds. So leave a comment down below on which fund you prefer and why. If you're still watching and enjoyed, I'd appreciate a like on the video, go ahead and subscribe, and I'll see you guys in the next one.